Hello everyone, welcome back. Grab a seat. Today we are going to dive deep into the engine room of one of Africa's biggest tech giants. We are talking about Vodacom Limited, of course. Vodacom Group Limited. We are looking at their 2025 performance and financial results. This is for the year ending 31 March 2025, in preparation, of course, for this year's results in 2026. Now, before we can get started, just a quick reminder. I am an independent analyst and Vodacom didn't pay me to say what I'm about to say, and they don't even know about this presentation. And importantly, this is not financial advice. I am not telling you to run out and buy their stock. We are here strictly to learn about business, strategy, leadership, and how to read the pulse of a massive corporation. Who is Vodacom today? If you still think of them as just a company that sells airtime and SIM cards, you are missing the big picture. They started over 30 years ago, right here in South Africa. But today, they call themselves a techco, a technology company, not just a telco, which is a telecommunications company. Their big ambition, connect for a better future. It sounds like marketing speak, but as we will see, they actually use this to drive their business model. Who actually owns them? They are listed on the JSE, of course, but the big boss is Vodacom Group PLC out of the UK, sitting on a massive 65% stake. What's also interesting for us locally is that the Government Employees Pension Fund, the public sector, actually owns 12%, and their BEE vehicle, Yeboyetu, owns 5.5%. So a lot of local wealth is tied up on how this company performs. In terms of their operating model, how do they actually make money? This is where it gets interesting. Vodacom uses something they call a system of advantage. Think of it like an ecosystem, They reel you in with the basics, data and voice. But once you are on the network, they want you using their super apps like VodaPay here in South Africa or M-Pesa in the rest of Africa. Why, you might ask yourself? Because connecting you to the internet is a once-off or one-time utility fee, but taking a tiny percentage of every financial transaction you make, that is a constant recurring goldmine for them. Their operating model is super smart. You build once and replicate everywhere. So, if they develop a great piece of software in Egypt, they don't rebuild it for Tanzania. They just copy and paste. Plus, having Vodacom UK as a parent means they need to buy network equipment from Ericsson or Huawei. They get the global bulk discount, which saves them an absolute fortune. Let's look at the map. Vodacom isn't just South African story, by the way, anymore. Although they've started here, they are a pan-African powerhouse with 211 million customers. South Africa is still the mothership. It's where they make the bulk of their revenue. But the real growth engine are up in the north. They recently bought a controlling stake in Vodafone Egypt, and it's a beast. It gives them access to a huge population, and crucially, they earn a lot of revenue there that is linked to US dollars, which protects them in case our currencies are weakening in the Southern African states. Then you have the international segment like DRC, Tanzania, and Mozambique. This is M-Pesa territory. In these countries, traditional banking is hard to access, so Vodacom essentially is the bank in those places. Finally, Safaricom in Kenya and Ethiopia. Vodacom owns a big chunk of them. Safaricom runs M-Pesa in Eastern Africa, and they process over $1.2 billion a day. What is the CEO Shamil Yousaf's master plan? They've just transitioned to what they call Vision 2030. The strategy is simple. Don't just be the pipe that carries the internet. Own the services that run on the pipe as well. They want to scale their beyond mobile revenue. Right now, things like fintech, IoT, and cloud make up about a quarter of their revenue. By 2030, they want that to be over 30%. They are aiming to reach 260 million customers globally. Initial goal, double-digit growth in their operating profits, EBITDA. To get there, they are betting heavily on expanding their 5G networks, laying more fiber and using artificial intelligence to run their networks more cheaply. In terms of the human capital and culture, you can't run a 200 million customer network without good people. Vodacom employs just under 17,000 employees. Now look at this metric, revenue productivity. Every single employee on average, they generate nearly 9 million rand. That's amazing. That is incredibly high and tells us that Vodacom is very lean, highly digitized, and as a business, and they don't need armies of manual workers. They need smart tech. They also score very high on employee engagement, 88% of their team spirit index, and they have pushed hard on diversity too, with over 41% of senior management roles led by women in a traditionally male-dominated engineering sector. That's definitely a significant shift. Now, let's look at the numbers. This year was tough. There was load shedding. Obviously, I'm talking about last year. There was inflation. There was currencies crashing in Africa, but Vodacom still pulled it off. Revenue notched up slightly by 1.5% to over 152 billion rands. But here is the magic trick. Look at the net profit. It went up by 3.3% to almost 20 billion. How do you actually grow profit faster than sales? Because you have cost-cutting measures there. They squeezed their operating expenses very hard this time. Their operating profit margin stayed perfectly stable at 23.5%. And their return on capital employed went up to 23.5%. That basically means for every 100 rand they invest in towers or spectrum, they are generating 23 rand 50 in operating profit. That's a very healthy return. The only slight dip was return on assets, ROA, simply because they've been buying a lot of heavy, expensive 5G and fiber assets that haven't fully started making money yet. If you want to know where a company is going, look at what they are buying. Firstly, they bought Smile Communication in Tanzania. Why, you might ask yourself? They didn't really want the brand. They wanted the spectrum, the invisible radio waves that actually carry data. Smile had a premium 4G spectrum and Vodacom scooped it up to make their own network faster. Then there's the drama with Massive. Massive owns Vumatel and Dark Fiber Africa. Vodacom wants to buy 30 to 40% stake there, and the Competition Commission initially said no, fearing a monopoly, but Vodacom has been fighting back, and I know for sure with the latest information that has been given a thumbs up to go ahead. We'll see. It shows how desperate they are to own the fiber cables in the ground, not just the towers in the air. Finally, they took their South African towers and spun them off into a separate company called Mast Services. This is a clever accounting and strategy move to let them share towers with competitors and make money off their rivals. Vodacom faced massive headaches. The biggest, currencies and inflation. In Egypt, inflation hit 33%, and in Ethiopia, it's basically hyperinflation. When you earn money in weak African currencies but have to buy network equipment in US dollars, you bleed cash. Their solution, they are aggressively localizing their costs. In Egypt, 85% of their operating costs are now paid in local currency. Then, of course, load shedding in South Africa. You remember those days, eh? They had to spend a staggering 5 billion on batteries and solar panels just to keep the network alive when Eskom dropped the ball. And they always face regulatory risks. Governments want a bigger slice of the pie, or political instability in places like DRC. So how does management plan, or what did they actually do to squeeze more profit out of a tough environment? Firstly, their Fit for Growth program. It's a fancy term for ruthlessly cutting costs so expenses don't rise as fast as inflation. And secondly is the artificial intelligence, AI. They are using generative AI to handle customer services and automate network repairs. Less human intervention means lower costs for them. Thirdly, infrastructure sharing, like building towers is expensive. They are increasingly partnering up to share the costs of the physical steel and concrete while competing on the software and services. And finally, pushing those high margin services. Lending you money via Vodapay is vastly more profitable than selling you a 1 gig of data. To wrap it all up, how does Vodacom actually stack up against the competition? Vodacom is playing a defensive growth game in this place. They are a cash-generating machine. They might not have the explosive growth of a startup, but they have incredible stability that is seen by a massive 35% cash flow return on investment. Compared to MTN, of course, MTN is actually a bit faster in raw speed tests right now, and their Nigerian market gives them higher profit margins. But Nigeria is incredibly volatile, as you might know. Vodacom is viewed as the safer bet because their anchor markets, which is SA and Egypt, are slightly more stable and they lead heavily in 5G. Compared to Telkom is fighting a price war at the bottom, trying to win the cheapest prepaid customers. Vodacom doesn't play that game, of course. They dominate the premium contract and corporate enterprise markets, which is why their revenue per employee is so much higher than Telkom's. In short, Vodacom is building an ecosystem that is very hard for customers to leave. And as long as they control the connection and the wallet, they remain a formidable force. Thanks for joining me on this session.